Good morning and welcome to the FINTEL PLC full year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all the questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll, and I'd now like to hand you over to CEO Matt Timmins. Good morning to you, sir.
Thank you very much. Good morning, and good morning to everyone watching. Thank you so much for tuning in today to the FINTEL FY22 results presentation. My name is Matt Timmins. I'm the joint CEO of FINTEL, and I'm delighted today to be joined by CFO David Thompson. David and I will take you through the presentation throughout the course of the next sort of 30 to 40 minutes, and we'll leave plenty of time for your questions thereafter. So we're going to start the presentation by giving a quick overview of the business for those of you who are less familiar with FINTEL, and also cover some of the main highlights during last year. I'll then hand to David, who will do a full review of an in-depth review of the finances, and then I'll come back and talk a little bit about the current trading and outlook for 2023. So for those of you who are less familiar with FINTEL, we operate right at the very heart of UK retail financial services. And we believe fundamentally that this is a brilliant market for consumers. UK retail financial services is a very vibrant market. Consumers have access to thousands of different financial products, anywhere from car insurance, pet insurance, all the way up to pensions and investments. And as I said, consumers have access to thousands of different products from hundreds of well-capitalized manufacturers at a price and value which is really commensurate with the competitive nature of that market. So a great market for everyone operating in retail financial services. Apart from those people who manufacture products and those people who are involved in the distribution or intermediation of that market, it's a very tough market to operate in. It's highly fragmented and it's heavily regulated. Around about 75% of all mortgages and around 80% of all investments end up in the hands of a consumer via an intermediary of some description. And as I said, the UK market is heavily intermediated. There's about 12,000 IFA firms operating in the market, 10,000 mortgage broking firms, and around 4,000 wealth management firms. So very fragmented market and highly regulated. And our job fundamentally is to help that market operate as effectively as possible. So we provide services to three different groups of customers in the market. First and foremost, we provide services to financial intermediaries. And those intermediaries are IFAs, their mortgage brokers, and their wealth managers. And all of those firms pay a monthly subscription for membership services. We don't provide one-off consultancy work, and we don't do ad hoc work. We provide all of the support and all of the services a firm needs to operate in this highly regulated market for a percentage of their turnover of their business on a membership fee. We collect that monthly via direct debit, and as David will come on to talk about later, we have excellent cash flows and really strong levels of recurring income because of the strength of the model. We also then provide services to product providers, and the services we provide to them are first and foremost helping them to distribute their products amongst this fragmented intermediary market. And secondly, we provide them with a layer of data based on what's happening out there in the market. Because many of the intermediaries we provide services to use the fintech that we provide, we have a level of data on an aggregated and non-personalized basis, which allows us to look through as to what products are being advised and why consumers are choosing them. So this helps intermediaries to be able to develop new products, product providers to develop new products and also to distribute them effectively. For consumers, we provide consumers with a product rating via de facto, a star rating, which is a look through to the sort of underlying componentry of the product. So these ratings aren't based on people's preference. They're not based on customer service. They're based on the underlying componentry of the product itself and essentially how good the product is. And we rate those 1 to 5 stars. And when consumers go on to price comparison websites or they go onto the de facto website, they're able to compare products against each other and use that star rating as a shorthand device. So we operate in an unrivaled market position right at the very heart of UK retail financial services. We have a product database of over 40,000 different financial products, which we research, compare and rate every year. And we have very strong trusted brands within the business. And I'll come on to talk about those two brands that we have. So we have SimplyBiz and Defacto. Both of those brands are incredibly strong. Defacto has a 75% consumer awareness rating, or 75% awareness amongst consumers. And SimplyBiz is the UK's leader in terms of providing compliance and regulatory services to financial intermediaries. We've won the Professional Advisor Awards for the last 5 years running as best service provider in the market. We've been going for 20 years in terms of SimplyBiz, and I've been there since day one, and Defacto have been operating for 29 years. We acquired Defacto back in 2019 with the aim that Defacto would provide fintech out into the market and also to the SimplyBiz intermediary firms. So that was a great acquisition. Both businesses are very different in terms of the services and products they provide, but fundamentally we have the same clients. So both Defacto and SimplyBiz provide services to intermediaries and to product providers. Both businesses are incredibly strong. They have strong levels of recurring revenues. They operate on solid margins, and both businesses are growing incredibly well. So the businesses work best when we have this sort of flywheel effect. So the more intermediaries who use the SimplyBiz services and the Defacto fintech, the richer and more valuable the data set that we produce. So the businesses work incredibly well together. It's the reason we bought Defacto back in 2019. And Defacto, when we acquired it, was making around 5 million a year. And at the end of 22, we've almost doubled the profitability and paid off all the debt with that business. The two businesses together operate, as I said, right at the very heart of UK retail financial services, and we are the only group to operate in the 4 different quadrants that you can see on the screen here. We have competitors in each one of those quadrants, but none of those companies provide services all the way across the quadrants like FINTEL does. This means that we have, as I said, many competitors in each individual market, and a lot of opportunity for M&A, and we'll come on to talk about M&A a little bit later. In terms of the performance for 2022, it was a very strong performance from FINTEL, 8% core revenue growth, coming in at an adjusted EBITDA margin of 33%. We operate strong cash flow conversion at 118%. We have spent time, energy, and money during 22 developing the business. We have produced new modules for our fintech, cash flow planning and pension switching modules, and we've also extended the offering that we deliver to our intermediary firms and built a new module around consumer duty. As we look forward, there's a really confident outlook. We have over 65% of revenues recurring from SaaS and subscriptions, so that gives us great visibility as we look forward. We have almost 13 million pounds of cash in the bank, plus an undrawn RCF facility of 80 million, giving us a lot of dry powder to go out and make acquisitions. And there are strong growth drivers. There is definitely an advice gap in the UK. The intermediaries are performing incredibly well. It is a market that is in growth. It is relatively slow growth. It's around 2%, but still a market that is in growth. And there are other factors such as consolidation in the market, which enables us to provide our fintech and services to larger consolidation firms as well as intermediaries. And with that, one more slide. So what I've included here is an overview of the revenue and EBITDA over the course of the last 3 years. So you can see that even during times of disruption, such as the COVID pandemic, and also during times where we have divested of some non-core assets, we have still continued to grow both revenues and EBITDA. And with that now, I will hand to David to cover off the financials in quite a bit more detail, and I'll come back in sort of 5 or 10 minutes time and go through the outlook for next year and beyond.
Okay, thank you, Matt. And again, good morning, everyone. So I'll take a run through the statutory measures, and then we'll focus in what we call our core businesses. That's the key area of growth and key driver of value. So you can see revenue grew to 66.5 million, and that flowed through to adjusted EBITDA of 19.4 million at the just over 30% margin, and flown again to adjusted PBT of 15.9 million. And the point there is that flows through to earnings and also importantly converts to cash. So adjusted earnings per share up from 10.5 to 12.2 pence. Cash flow conversion on an operating profit to operating cash basis at 118%. There's a slide further on where we show a couple of other measures in terms of EBITDA conversion and free cash flow to equity. So you can see how that converts all the way through to the ability to pay dividends and the operating cash inflows. So again, 19.3 million of operating cash inflows correlates extremely highly to 19.4 million of adjusted EBITDA. So if we look at the revenue stack, what we can see here is there's 10.1 million of revenue from the non-core business, and the balance 56.4 million coming from the core business. Now, we have the non-core business. It's a property surveying business. It's a great business. It's a profitable business. However, the whole ethos and way of creating value is to have that white flywheel effect that Matt talked about in terms of an ever-enriching data set. The property surveying business, it has an adjacency to the mortgage part of our business. However, it relies on qualified professionals to go out and physically inspect homes. Therefore, it's difficult to digitize that business, and rightly so. It relies on a bunch of talented people up and down the country doing that. But the margins there are very dilutive compared to the rest of the group. So if we focus on the core revenue going forward through the rest of the presentation, that will highlight the key drivers of value. So of the core business, the bottom green section there, 2/3 of it is what we call SaaS and subscription revenue. So that is either monthly direct debits coming from membership income or monthly direct debits coming from those members that subscribe to software services. The other section, 19.6 million there, whilst it's not technically SaaS or subscription in nature, it's very highly repeating. So again, the revenue quality in the entire core business we think is really strong. And a couple of examples of that are the mortgage business. So we have a mortgage panel that has thousands of mortgage advisors as members, and we act as an intermediary between them and the lenders. So we take a small bit share of a clip of the ticket on the way through. So it's transactional in nature and rises and falls with the general housing market, but it's very profitable and it's very highly repeating, so very high quality revenue. The other part of the business is the de facto ratings product, and again, huge amount of repeat customers, repeat business. However, it's an annual vintage, so it's 2021, 2022 5-star rating, etc. So you can't really call it mechanically a SaaS or subscription style revenue, but again, highly repeating. So we'd like to think that the revenue quality of the whole core business was very strong. If I zoom into that core business, you can see here that across the last 3 years, and Matt alluded to it in an earlier slide, that we've had growth in the core business across all 3 key metrics in terms of revenue, EBITDA and EBITDA margin. And importantly, that's through some difficult times in terms of the COVID pandemic and also making some strategic divestments. There's still growth on an absolute as well as like-for-like basis. Again, a testament to the compounding nature of the revenue model. And on the right-hand side, we've got a bridge to take you back from 18.6 million of core EBITDA on the right-hand side back through to the statutory 16.7 million number, so you can just see how we arrive at that analysis. We can then further zoom in and take the core business and split it into 3 financial reporting segments, but importantly addressing 2 key customers, the intermediaries that are our members and the product providers and manufacturers and lenders that have those intermediaries as their respective customers. So if we work left to right here, in intermediary services, revenue of 23.5 million, that's basically 11.5 million of monthly collected direct debit membership fees from thousands of member firms. Another 6 million approximately of software licenses for their back office software that these firms take from us, and another just under 6 million of additional services in terms of if that firm grows and they take on additional advisors, they'll need training, CPD, additional file reviews, other matters of compliance and regulatory compliance. So that 23.5 million is very, very highly repeating business. And in distribution, that core thousands of members attract the product manufacturers, and they pay us just around £13 million to effect marketing services, upsell of insurance products, PIs, particularly relevant there, and that's also where the mortgage business sits. And then fintech and research, half of that business sells a fintech workflow advice piece of software to the intermediaries, and the other half of it deploys ratings and other associated products to the product providers. So you can see the core business, very, very sticky recurring revenue streams, 2/3 of it from direct debit ostensibly, and a very sticky customer base of thousands of intermediary firms and hundreds of product partners and manufacturers. If you, again, reconcile that back to the statutory total, you can see the core, which is the summation of the three segments on the previous slide. You can see that gives a gross margin of 53.9%. We show the non-core business at the side, and you can see that that's a margin of 7.9%. So you can see how dilutive it is to not show the two separately. So again, the key driver of value is in that core business at 53.9% gross margin and a 33% EBITDA margin once all other costs are baked in. So again, high single-digit revenue growth, which is sustainable. It's compounding and at very good margins and at very high cash conversion, which we can see on this slide in terms of the first green bar there, telling you that the operating cash flow conversion 118%. We would guide that would typically be between 100 and 120%. Then you've got adjusted EBITDA to operating cash flow. That would typically be between 90 and 100%, depending on working capital. And again, we're in the range. And again, you can see effectively free cash flow to equity at the bottom coming out at 71%. And that's after tax and debt service costs. So you can see that's in the range of 70 to 75 as well. And what that means in terms of the balance sheet strength, this is a real strength of the business as it stands. So in 2019, as Matt said, we acquired De Facto for just under £75 million. And we approached that in terms of structuring the transaction of half of it was equity from an additional raise, and half of it was debt in the form of a revolving credit facility. And really, once acquired, the two main drivers were to integrate the business well, integrate it quickly, and realise synergies such that it improved the cash flow within the business, and we paid the revolver off as quickly as possible. And you can see there that within 3 years of acquisition, De Facto's debt has been completely paid off. So we own the business outright, and the De Facto business has gone from just over 5 million of EBITDA to just under 10 million of EBITDA in those 3 years. So a great acquisition, great demonstration of our track record and our ability to integrate material M&A. And on the back of that, we decided to increase the revolving credit facility from 45 to 80 million. So that gives us almost 100 million of our own internal dry powder resource to go and effect M&A to grow the business faster than the mid to high single digit growth that we set a target for ourselves organically. And again, in summary, a robust financial performance. Again, that's every year since IPO in 2018 that we've hit our numbers in the market, and again, that's done by increasing the revenue quality in the core business, because you not only increase the quantum of revenue, you increase the longevity of it by longer term contracts. A strong cash generation, and that gives us significant financial resources to invest in the business, both organically and through M&A, and that gives us the ability to put the dividend up 8% to 3.25 pence for FY22, in line with the rise in profitability of the company. And with that, I'll pass back to Matt.
Thank you, David. And I can see some great questions coming in already from Kevin, Steve, and Tom. I'll get to those at the end of the presentation. Cover those in some detail. So thank you for those. So as David said, divisionally, we've performed incredibly well during 2022. We've increased profitability in the intermediary services division by 28%. We have increased the earnings quality in distribution. So distribution for us was about moving annual contracts to long-term contracts where we have a monthly revenue and a recurring revenue and the ability to escalate prices. So we've converted 70% of the revenue, which was ahead of our initial target of 60%. So that's great performance in that division. FinTech and research, which is the de facto business, we've increased revenues in that business by 19%. Again, underlying what a really solid acquisition that was. So in terms of the de facto business, the fintech that business operates, that's used by intermediary firms, we're now seeing flows of around £42 billion worth of advice through that fintech each and every year. So again, we're getting some really solid traction amongst some intermediaries, and the growth in AUM is flowing through that platform nicely. So onto the next slide. I've seen that we had a question which I think was from Tom on FINTEL Labs. So great that we can cover that now. So FINTEL Labs is essentially our incubator to help new start fintech businesses in the UK. Very often we see some great businesses that are at too much of an early stage for us to acquire, because we would have to consolidate potential losses into the P&L. So we're using the incubator to make early stage investments into businesses that we believe will grow well. And it's not just about the sort of financial resources and the investment of cash. It's also about the investment of our time and energy and our people to help those businesses grow. Very often it's useful for early stage businesses to have a solid distribution partner to work with to help them scale more quickly. So FINTEL Labs is about using our financial resources and our people resources, our IP and knowledge to help early stage businesses to grow. Very often we expect through FINTEL Labs to have a sort of call option structure to allow us to invest more into the business as it grows and to take a greater level of control over time. So it's not a sort of incubator where we're acting as a VC and sort of throwing cash into any business that we see. These are businesses that we believe over time we will want to own a significant majority or 100% of, and therefore we're investing in an early stage to give us the best possible start. In terms of sort of total investments, it will be sort of low to mid single-digit millions that we'll invest in over time. So again, we're not placing huge bets here. We are making investments into businesses that we think have got a great opportunity for growth in our market. Our business takes ESG incredibly seriously, and we do it in a very particular way. So first of all, we have written to all shareholders, stakeholders, staff and customers and asked them to complete a materiality assessment. And I think that's really important. So rather than the business deciding what we're going to focus on, we've asked our customers and our stakeholders to tell us what they think is the most important area of ESG to focus on. And primarily for our business, it's around governance, it's around data security, and it's around how we treat our employees. In addition to FINTEL's drive towards better ESG, We also have a de facto business that does fund reviews to around 110 investments and has about 8,000 intermediaries using those ESG reviews when giving advice to clients. So we are right at the very heart of this ESG market in terms of the work that FINTEL does and also in terms of the work that de facto does for intermediaries and consumers. In terms of our staff, because as David's pointed out, we are primarily a people business. We have really happy and incredibly engaged workforce. We participated in the Best Outstanding Companies to Work For in 22, the first year we've done that, and we got a 2-star outstanding accreditation. The best you can get is 3 stars, so we've performed incredibly well in our sort of first year of applying for that. We came in the top 25 financial services to work for in terms of best companies. We have an 82% engagement score amongst our workforce and 6 years average tenure. And importantly, I think on the left-hand side, a couple of statistics that we're really proud of. So 23% of all vacancies in 2022 were filled by an internal candidate, which demonstrates real internal mobility. And 50% of all leadership vacancies last year were filled by females as well. So really high levels of engagement amongst our staff. As we look forward to this year, to 2023 and beyond, we believe that there are some important growth drivers that really give us confidence that the business will continue to grow well. So every time regulation gets tougher and every time regulation increases, it's another potential reason for those intermediaries who aren't customers of ours to join and to receive the services that we offer. There is also a demand amongst the intermediary market to reduce the number of individual technology systems they use. The average number is around 9 in the market. And so what our acquisition of de facto does is give us a solid piece of technology to build on. And we are adding new modules all of the time, which decreases the need for intermediaries to go elsewhere for the solutions that they need. There is also market consolidation happening. So there's quite a lot of investment gone into private equity investment gone into consolidating advisors. And that does kind of 2 things for us. First and foremost, it allows us to provide services to consolidators, whereby it is essentially a smaller number of firms who will join the business, but they will pay a higher amount because they require greater services and more fintech. And then over time, you tend to find that individuals who've been consolidated decide to set back up again on their own, and that will provide another pool of customers for us. The business is currently trading in line with board's expectations. We are continuing to deliver organic growth, and we have a lot of funds available for M&A. We have a very active pipeline at the moment. So we're talking to some really great businesses about bringing them into the FINTEL family. And we believe that we're well positioned for sustainable growth. So just to summarize from me, and then we'll get on to Q&A. We operate this unique platform right at the very heart of UK retail financial services. We have 2 leading brands in the market, both of those businesses highly respected, and they have engaged and loyal customers. That gives us an integrated model combining technology and services platform, and we're a clear leader in the wealth management space. We've got broad connectivity across the market and great opportunity for M&A, and a very ambitious leadership team with a real key growth agenda. So I'll now turn to M&A if I can, and I think we've got a few questions here. As I said, I believe I've answered Tom, so I'll go first of all to Kevin. Kevin's question was around the market itself and what percentage of the market that we currently provide services to, and also about international expansion, picking up on a point that Steve's made here. So we provide services to around 3,000 intermediaries. As I said, there are about 12,000 IFAs, 10,000 mortgage brokers, and 4,000 wealth managers. So there is plenty to go at in terms of expansion of core customers. And I think that answers the second point in the question around international expansion. So there are currently no plans for us to go into other markets. We do occasionally look at other markets internationally. So we know and understand and are very close to the market in South Africa. We also have a lot of information on the market in Australia. However, I think that the opportunities in the UK market are massive, and international expansion is quite a risk. And I believe that we're best off to put our pounds into the UK market and grow our business in that way. So no plans for international expansion at this point. Chris asked a great question about finding and attracting and recruiting talent and developers in the team. So I'll hand that one over to David, if I can.
Sure thing. So again, just going back to the slide around the engagement of staff, and the financial reward, it's fair to say, is quite wholesome. We offer a number of other benefits and that are comparable with companies in the market. But there's a big sense of purpose, especially in the de facto software developer team, because it's those people that built the Engage software. So it's their internally developed IP. So they've got a vested interest in sticking with it and improving the software. And again, looking at the UI and UX experience at the moment as part of the technology roadmap. So it's a very happy team. It's a very long-standing team. We've got very strong management locally, and our staff turnovers between 10 and 15%, which is absolutely normal for the market, and arguably slightly better than what has been recently a pretty buoyant market. But yeah, so again, I'd probably summarise that by saying we've got a well-rewarded, well-engaged, and happy staff base, and long may it continue.
Thanks, David. And a couple of great questions coming in from Chris B. So I'll take the first one, and then I'll hand to you, David, for the second one. So the first question is, how would you describe the current role of your founder, chair, and largest shareholder, Ken Davey? And is there any related reason why you have a joint CEO model? So first of all, turning to Ken. Ken founded this business back in 2002 and has been instrumental in the growth and development of the business over that period of time. Ken is 82 years of age and has decided to step back to be a non-exec director, which I think is absolutely right for Ken. He hasn't been active from an executive point of view in the business since 2010. So very comfortable for Ken to step back into being a non-exec director. We have appointed a guy called Phil Smith. Phil operated a business called Embark, which bought out the Zurich's retail platform and then sold Embark to Lloyd's a couple of years ago. So Phil's been in the market for a very long time. He's incredibly well schooled in M&A and has a lot of great connections. So we're really looking forward to having Phil take the chair after the AGM, and also looking forward to Ken continuing to work within the business as a non-exec director. In terms of the joint CEO decision, Ken appointed Neil and I to run the business back in 2010. I have been with the business since it started in 2002. Neil joined in 2003. I was originally marketing director and Neil operations director. So we have a very different set of skills, very different backgrounds, and we find they're incredibly complementary and we work well together. So I know that the decision around joint CEOs isn't always the most popular. And I think very often when you bring two CEOs together who don't know each other well, there can be fallouts and boardroom struggles and politics and all that sort of stuff. Neil and I have known each other since we were 6 years old, and we've got all our arguments out of the way with. So we work well together, and I guess the proof is in the last 12 years worth of performance since we've taken on that role together. Chris then asks around, why do you stay on AIM rather than shift to the main market? And I'll pass that one to David.
Are you sure? So it's a great question. I think so we do look at this. A market capitalisation at circa 200 to 250 million, where the business has traded over the last couple of years, it's relatively low for a main listing. There are absolutely main listed companies with market caps that size, but I guess our view, rightly or wrongly, is a move to the main market would be when you had some comfort that you would get some index money following behind you in terms of being FTSE 250 and have some trackers in there, and that's obviously up at the 800-900 million range, or it was when we looked. So I think a wee bit off to move to AIM. Certainly, it would be fantastic to the main list. Rather, it would be fantastic to reach the heights of that market capitalisation and have that as a more prevalent live decision. But AIM suits as well. The support of our current shareholders is fantastic. Certainly wish there was a bit more liquidity in the stock, that's for sure. But the proof in the pudding was when the business managed to raise within a week the equity element to acquire de facto and get the backing of those shareholders after a very swift roadshow. That just tells you that AIM's not a bad place to be when its function of raising additional money to grow the business is required. So, again, hopefully that answers the question.
Thanks, David. And on to the final question that I have here on the Q&A. So David asks, when can investors see the incubator investee companies? David, we absolutely will be publishing those businesses that we've invested into. At the moment, there is only one, but there is more in the pipeline. And we'll be talking about those when we have essentially done something of note with the business. So, for example, when we've created either an integration or we've licensed one of their products or we've started to see some customers come on board. Very often, as I said, these companies will be at real early stages. And so until we've done something material, we won't be announcing just a sort of standard straightforward investment. We'll wait till we've got something really strong to talk about.
Matt, David, thank you very much. I think you actually managed to address every single question from the investors. And of course, the company will review all questions submitted today and will publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which I know is particularly important to you both, Matt, could I just ask you for a few closing comments?
Yeah, absolutely. So, I'll begin first of all by thanking everyone for tuning in. I know it's taken an hour of your time, and hopefully you found the presentation really useful. So what I would say in closing is that the FINTEL business is a 20-year-old business. We have used that time to develop really strong customer relationships. We support around 30% of the intermediary market in some way, shape or form, either through membership services or through the provision of technology. We have incredibly strong brands in de facto and Simply Biz. We have a proven track record of delivering growth and returns to shareholders. And we have a proven track record of being able to acquire really great businesses for a good price, pay down the debt and increase the profitability of those businesses. So in closing, we believe that our business is set for continued growth. We think the financial model that we've got is incredibly strong and resilient. And we believe that 2023 and beyond will be good years for the business, where we continue to develop out the FinTech platform, grow our customer base and grow both revenues and EBITDA. So thank you very much for tuning in. It's been a pleasure and hope to see you all soon. Thank you.
Matt, David, thanks once again for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of FINTEL PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.